Have you ever wished you could pool your money with others to invest in a diversified portfolio of assets? That's the basic idea behind mutual funds. Think of it as a basket of stocks, bonds, or other investments. When you invest in a mutual fund, you're buying a share of this basket. Mutual funds are managed by professionals called fund managers. These experts use their knowledge and experience to select the assets in the fund's portfolio. Their goal is to achieve the investment objectives outlined in the fund's prospectus. Imagine you want to invest in the stock market, but don't have the time or expertise to research individual stocks. A mutual fund specializing in stocks could be a great option. Whether you're saving for retirement, a child's education, or simply growing your wealth, there's likely a mutual fund out there that aligns with your financial goals. The world of mutual funds is vast and diverse, offering a wide range of investment options to suit different risk tolerances and financial goals. Let's explore some of the most common types. Equity funds. These funds invest primarily in stocks, aiming for capital appreciation. They offer the potential for higher returns but also come with higher risk. Equity funds can be further categorized based on company size, such as small cap, mid cap, or large cap funds. Debt funds, also known as bond funds, these funds invest in fixed income securities like government and corporate bonds. They are generally considered less volatile than equity funds and provide regular income in the form of interest payments. Hybrid funds. As the name suggests, hybrid funds invest in a mix of equities and fixed income securities. This blend aims to balance risk and return, offering a middle ground between the volatility of equity funds and the stability of debt funds. Money market funds. These funds invest in short-term, high-quality investments such as treasury bills and commercial paper. They are considered very low risk and provide liquidity and stability, making them suitable for investors who need easy access to their funds. Target date funds. These funds are designed for investors planning for retirement or other long-term goals with a specific date in mind. Target date funds automatically adjust their asset allocation over time, becoming more conservative as the target date approaches. Investing always involves some level of risk, and mutual funds are no exception. Understanding the different types of risks associated with mutual funds is crucial for making informed investment decisions. Systematic risk. This type of risk affects the entire market, not just specific securities. Market risk. This refers to the potential for losses due to overall market fluctuations. Interest rate risk. This risk primarily affects bond funds. When interest rates rise, the value of existing bonds tends to fall. Inflation risk. This risk refers to the potential for inflation to erode the purchasing power of your returns. Unsystematic risk. This type of risk is specific to a particular company, industry, or sector. Credit risk. This risk is most relevant for bond funds. It refers to the possibility that a bond issuer will default on its debt obligations. Liquidity risk. This risk relates to the ease with which you can buy or sell a particular investment. Some mutual funds invest in less liquid assets, which may be difficult to sell quickly without incurring significant losses. Currency risk. This risk is relevant for funds that invest in foreign securities. For investors seeking to safeguard their capital and minimize potential losses, certain types of mutual funds offer a lower risk investment approach. Let's explore some of these options. Money market funds. As we discussed earlier, money market funds invest in short-term, high-quality debt instruments like treasury bills and commercial paper. These investments are considered very safe and highly liquid, making money market funds an attractive option for investors seeking stability and capital preservation. Government bond funds. These funds invest primarily in U.S. government bonds, which are considered among the safest investments in the world. The U.S. government has never defaulted on its debt, making these bonds highly attractive to risk-averse investors. Government bond funds offer a steady stream of income and are less volatile than funds that invest in corporate bonds or stocks. Short-term corporate bond funds. These funds invest in corporate bonds with shorter maturities, typically 1 to 3 years. Shorter-term bonds are generally less sensitive to interest rate changes than longer-term bonds, making them a relatively low-risk option within the corporate bond category. However, it's important to remember that corporate bonds, even short-term ones, carry some level of credit risk. Embracing risk for higher returns. Exploring riskier mutual fund options. While low-risk mutual funds offer stability and capital preservation, some investors are willing to embrace higher risk in pursuit of potentially higher returns. Let's explore some of the riskier options within the mutual fund universe. Equity growth funds. These funds focus on investing in companies that are expected to grow at an above-average rate. Growth companies often reinvest their profits back into the business rather than paying dividends, so investors are primarily seeking capital appreciation. Small cap funds. These funds invest in companies with smaller market capitalizations, typically those with a market cap of less than $2 billion. Small cap companies have the potential for rapid growth, but they can also be more volatile and risky than larger, more established companies. Emerging market funds. These funds invest in companies based in developing countries. Emerging markets offer the potential for high growth, but they also come with higher risks, including political instability, currency fluctuations, and less developed regulatory environments. Sector-specific funds. These funds focus on investing in companies within a particular industry or sector, such as technology, healthcare, or energy. Strategies for success making money with mutual funds. Investing in mutual funds can be a rewarding way to grow your wealth over time. Here are some strategies to help you maximize your returns. Long-term investment and compounding. One of the most powerful concepts in investing is compounding, often referred to as the eighth wonder of the world. Compounding allows your earnings to generate even more earnings over time. By investing for the long term, you give your investments more time to compound and grow exponentially. Diversification. Don't put all your eggs in one basket. Diversifying your investments across different asset classes, sectors, and geographies can help reduce your overall risk. Mutual funds make diversification easy, as they inherently invest in a basket of securities. Selecting funds with consistent performance and low fees. Past performance is not necessarily indicative of future results, but it can be a helpful starting point when evaluating mutual funds. Look for funds with a consistent track record of outperforming their benchmarks over the long term. Mutual funds versus stocks. Which path aligns with your goals? Investing in the stock market? You have two primary options: individual stocks or mutual funds. Mutual funds offer instant diversification, reducing risk. Individual stocks require building your own portfolio. Mutual funds are managed by professionals. Individual stocks need your own research. Mutual funds charge management fees. Stocks involve brokerage commissions. Stocks can offer higher returns but with higher risk. Mutual funds are less volatile, offering a smoother ride. Choosing the right path. Factors to consider when selecting mutual funds. With thousands of mutual funds available, selecting the right ones for your portfolio can seem overwhelming. Here are some key factors to consider. Investment objective. What are your financial goals? Are you seeking growth, income, or a combination of both? Make sure the fund's investment objective aligns with your own financial goals. Risk tolerance. How much volatility are you comfortable with? Different mutual funds have different risk profiles. If you're risk-averse, you'll want to choose funds with a lower risk profile, such as bond funds or balanced funds. If you're comfortable with more risk, you might consider growth funds or small-cap funds. Past performance. While past performance is not a guarantee of future results, it can be a helpful indicator of a fund manager's skill and the fund's overall strategy. Look for funds with a consistent track record of outperforming their benchmarks over the long term. Expense ratio. The expense ratio represents the annual percentage of assets that the fund charges to cover its operating costs. Conclusion. Empowering your financial journey with mutual funds. Mutual funds offer a versatile and accessible way for investors of all levels to participate in the financial markets and work towards their financial goals. By understanding the different types of mutual funds, the risks and rewards associated with each, and the strategies for success, you can make informed investment decisions and empower your financial journey. Remember to invest for the long term, diversify your portfolio, and choose funds with consistent performance and low fees. With careful planning and a disciplined approach, mutual funds can be a valuable tool in helping you achieve your financial dreams.